What's up, guys? John here. Corporate bankruptcies have surged 118% last month, and layoffs have now hit the 2009 levels. According to Forbes magazine, this just came out yesterday.
The layoffs are already piling up this year.
The new year is not starting off on a happy note for workers, with more layoffs just announced.
And CNBC reported the same exact thing as of this morning, 9:43 a.m. Layoffs rise the highest of any February since 2009. Now, when you look at what's happening in the job market and the labor market and corporate bankruptcies, and then you look at the real estate market, none of it makes any sense. Home prices are through the roof nationally.
Mortgage rates and home prices are still on the rise.
Home prices continue to skyrocket.
I mean, there's homes in Compton now selling $600,000 or listing for $600,000, $700,000, $800,000, almost $900,000 for Compton, California. Home of the NWA, all the rap songs. You know, people aren't thinking you go to Compton to spend $1 million. You know, people think you go to Compton to get an affordable place to live. No longer the case. What's happening in real estate and what's happening in the job market are two different worlds, and soon they're going to collide in an epic way. According to the IMF, Janet Yellen and Jerome Powell, what they're saying happens next is going to shock the entire country. And I'm going to break this down for you. I'm going to show you, in their words, what's coming. I'm going to show you factually what's happening in real estate and what's happening in the job market to help you and position you for what I believe is going to be a situation where millions of Americans are going to be forced to sell their homes, their cars. They're going to be forced to sell off assets to try to survive. That's what's coming. Please hit the like button, hit the like button. YouTube will share the content, educate more people about what's going on in America's economy. And if you'd like to fix your credit, we would love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow, for Friday. Take a look at this. So loans right now for small businesses, above 9%. I'm hearing closer to 12 to 15, 16% depending on their credit. Now you look at this situation, it's unreal. It's shocking. February commercial bankruptcies surged 118%, just came out March 5th, right? In the U.S. cities, $150,000 is now considered lower class, lower middle class, right? So you might think, look, this is going to be Manhattan, it's going to be, Los Angeles, it's going to be San Francisco. Sure, San Francisco's on the list, but so San Jose, Seattle, Gilbert, Arizona. Who would think Gilbert, Arizona? Plano, Texas, Scottsdale, Arizona, Washington, D.C., and Chandler, Arizona. You have to make $150,000 a year to be basically lower middle class. Now, you start to add this up. How is this going to be sustainable? The average lawyer is making $135,000. So you think about this. Who's buying these homes? You might see all these homes listed for sale. Say, oh, you know what? The housing market, it's still red hot. You hear the data, you hear all this news. The housing market's really, really strong. Well, who's going to buy these homes? You have the average lawyer making $135,000. The average doctor, some say $187,000. Some are saying, on Reddit, they're saying $350,000. Call it $200,000. Call it $225,000. That's a doctor that went to school for 8 years and took on $200,000 worth of medical, debt to become a doctor, right? This is not the average person. Now, when you start to look at what's happening, it is absolutely unreal. For example, this property here on Sloan Avenue in Compton, $875,500. I thought maybe this seller is just crazy. Maybe they're just, wishful thinking to ask for almost $900,000. And I figured, a lot of these homes in Compton probably $400,000, $500,000, $600,000. No, $650,000 for this little property here. 1,000 square feet in Compton for $650,000. Like, that's crazy. They put some IKEA finishes on it, $650,000. $610,000 for this. There's one house here. This is $480,000. Look at this. It looks like an old garage for almost $500,000. 900 square feet, 2-bedroom, 1 bath. Right? This is the market we're in. So you have to ask yourself, who's going to be able to afford this property? Well, if you're making $200,000, let's say you're a doctor and you have this ambition of moving to Compton, maybe you want to live down the street from the NWA rap songs, right? $200,000, and you have monthly debts of $500, which if you're a doctor, you probably have student loans probably a lot higher than $500. You can barely afford it. If you spend an extra $1,000, you can't afford it. In the blue it's going to stretch your budget, right? You're too thin. You're going to probably need to make $300,000 to be able to afford it. I mean, this is where we're at. This is where we're at. $250,000 you can make it to Compton. It's absolutely crazy. And so when you see all of these properties being listed for sale, I don't believe there's buyers for them. I don't believe there's buyers for them. What I think is going to happen very, very soon as this labor market starts to fall apart is these sellers are going to be a hell of a lot more motivated to get out from underneath of these properties, because insurance is going to continue to go up, taxes are going to continue to go up, the cost of food, everything is going to continue to rise, yet the wages are going to fall apart. Wages are going to continue to fall apart and erode. Now, what's crazy is you start to look at, it's across every single industry, whether it be media, small business, tech, every industry right now is issuing massive, massive layoffs. UPS, every industry. And so you start to kind of connect the dots here, and then you look at this massive black swan event that nobody else is talking about. You can see one thing very, very clearly. It's going to be the greatest rug pull in American history. In 2020 and 2021, interest rates are at record lows. Money was everywhere. And people use that money as down payments to buy, cars for 20, 30% over sticker price, buy homes, $50, $100, $200,000 over asking, waiving inspection contingencies, appraisal contingencies. They wanted to just buy, prices was kind of irrelevant. Well, now that's changed. Interest rates have tripled. And inflation's gotten out of control, and now this is about to hit the job market. Default risk loom for nearly $2 trillion in corporate debt. Now, for context, the entire commercial real estate market, every single commercial property in America, any building 5 units and above, any multifamily property 5 units and above, any office building, any industrial property, if you took them all together, that's a $20 trillion market. $20 trillion. That's 10% of the amount of debt that businesses have that they need to refinance over the next few years, right? That's how much debt these companies have. And when they're going to have to refinance this debt at a much higher interest rate, they're going to have to cut a lot of costs. How are they going to cut this cost? By getting rid of staff. That's how they're going to cut the cost. Investing in robotics and tech and trying to streamline their processes, outsourcing talent overseas. They're going to do whatever they have to do to try to stay in business as the cost of capital continues to rise through this. So default debts loom for nearly $2 trillion in junk debt as U.S. companies hit with higher interest rates. Default and refis are climbing for U.S. companies over the next several years. Moody's said junk-rated firms have $1.87 trillion in debt maturing over the next 5 years. Right, that was last year, so the next 4 years. So you're seeing this, then you're seeing the amount of debt that's behind. Consumers are behind on. Texas, all these different states, 15, 20%, 30% of consumers behind on their bills. You have to ask yourself, how is this gonna have a soft landing like we've been promised? Fed, this came out today. Powell says, don't expect rate cuts imminently. There's not going to be rate cuts in 2024. I can almost promise you. I'd be willing to put a bet on that. And they said that there's going to be rate cuts in 2023. I said there's no way. 2024, March cuts, they're out the window. We're not going to likely see rate cuts. And because of this, you even see, this came out 1 hour ago, Barron's. Fed is talking to banks with high levels of uninsured deposits. The Federal Reserve is keeping a much closer watch on the banking sector these days, particularly given the concerns around commercial real estate. While Chair Jerome Powell maintains that stress within the commercial real estate sector and the risk it poses for banks is manageable situation at this point, he said the Fed is proactively addressing it. We have identified the banks that have high commercial real estate concentrations. 70% of all commercial real estate loans are held by regional banks. So this is a massive, massive storm coming to regionals. 70% held by regional banks, right, of commercial real estate. So particularly office and retail and other ones that have been affected a lot. He said, in response to questions from the senator, we identify them and we're in dialogue with them. Powell added that the Fed has been talking to these regionals and smaller banks for some time now, but that does not mean that having a game plan will forestall the issue. I'm sure there will be bank failures. That's not just him. Many billionaires have recently come out saying there's going to be hundreds of banks that are going to fail. Hundreds. One just actually came out yesterday saying there's going to be 500 regional banks that are going to be going down or consolidating due to this. Emphasizing that smaller, medium-sized banks, rather than having big banks that are at risk, we're working with them. So they're saying, the big banks are safe. That's going to be the conversation. They're going to try to push all of the capital to these big banks. And as these regionals start to fall, unfortunately, that's where America is going to start deploying a lot of their savings. So you see this, and then you see, what IMF warns of new banking crisis year after Silicon Valley. When did this come out? March 5th, right? It came out 2 days ago. A year after Silicon Valley Bank collapse, the International Monetary Fund has warned that U.S. lenders' continued exposure to risk could spark a new financial crisis. Now, I know we've been told, we're going to have this soft landing. Janet Yellen has said the same thing. Look, these moves held a promise of setting the economy on a glide path to a proverbial soft landing. I'd like to believe her. When did this come out? 2007, right before the great financial crisis, right? This is the same exact scenario we're going to walk through, except this time the debt that the average household holds is twice that of the great financial crisis. The average American over 18 years old has $100,000 or more in debt, whether it be student loans, credit cards, mortgages. That's the average. If you're in Washington, it's close to $180,000 individually. So you start to look at this. Most people are underwater in their cars. They're underwater in their homes, many of them. They think that their home prices are, where Zillow says they are. But when you go on Zillow and you start looking at recently sold properties, home sales are at a 30-year low. Home applications at a 30-year low since 1995. I mean, you're seeing a massive pullback. Consumers don't have the money. All they have is debt. And many of these Americans are unable to even pay these debts where they stand now. Wait until the job market falls apart. Telling you, some huge investing opportunities are going to be, available. And that's why private equity and a lot of these large institutions are sitting on so much dry powder. They're getting ready to buy America. Drop below. Let's have a conversation about this. What do you think about this? The job market, corporate bankruptcies, all of this coming to a head at the same exact time. Do you think we're walking into a massive tsunami of problems for the U.S. economy? Love to hear your opinion on it. Drop below. We'll have a conversation about this. If you'd like to fix your credit to position yourself for this, if you have ambitious goals, make sure your credit score is in line with your goals. As the economy starts to deteriorate, banks are going to get more careful about lending and whom they're going to lend funds to. So make sure your credit score is in line with your goals. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any issue at all in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. One late payment can drop your credit score upwards of 180 points and stay in your report for 7 years. So if you have any issues, even one issue, book a call below, and I'll catch you next video.